Now that you've been introduced to the Artesis approach to managed accounts, let's take a closer look at the science behind it all. So how do we create portfolios that seek to balance risk with return? Let's take a closer look at the asset classes in this portfolio. Think of asset classes as different types of investments. This portfolio contains a certain percentage of different investments, such as stocks or equities, bonds or fixed income, money market or cash equivalents, real estate, and commodities. While individual stocks, bonds, and other funds can perform in different ways, they are grouped together into classes. This grouping is done because they respond to market conditions in a similar way. Let's look at a real-world example of an asset class. Represented here is the asset class technology, as represented by the Chicago Board of Options Exchange Technology Index. Now, if we take a look at Cisco, a technology stock, and how it performed relative to its asset class, we see that it tracked it very closely during this initial rising period of values, and remained close during this declining period of values. So, as asset allocators, when asked at the end of this 3-year period why Cisco performed the way it did, we answer, because it tracked its asset class. In other words, investors wanted to own the asset class technology during this early phase, and in doing so, they diversified their portfolios by purchasing technology stocks such as Cisco. During the later declining period, investors wanted to own less of technology, and consequently, they started selling their technology holdings. This explains 90% of the reason why Cisco performed the way it did. The other 10% explains why Cisco did not perform exactly as its asset class, or as other technology stocks. This would be explained through the fundamentals of the stock, price-earnings ratio, forecasted annual earnings per share, market share, and so on. When we look at additional technology stocks such as Micron, Intel, and Texas Instruments, we see that they all followed the same general pattern. So at the end of the 3-year period illustrated here, we suggest the most important questions to ask are, should I have even owned technology? And if so, how much of it in comparison to my other holdings? At Artesis, we focus on the asset classes because they can be attributed to the majority of the return and not the individual securities. When constructing our portfolios, we do a great deal of statistical analysis to help determine which asset classes to choose. In doing so, we look closely at 3 specific variables and use over 20 years of historical data as a basis for our calculations. The variables are expected rate of return, risk, correlation. Let's look at a sample asset class to demonstrate the first variable. In a 5-year stream of returns, it had 4 positive years and 1 negative year, with a mean return of 6.2%. If we add a second asset class that had the same rate of return, which one would you pick? The data shown here does not give you enough information to make that distinction. Looking at variable number 2, risk, will help. We measure an asset class's risk using standard deviation to show us how much variation there is from the mean return, or spread of the potential returns you may see. You can see that asset class number 1 has a risk level of 5.5%, while asset class number 2 has a higher level of risk at 23.9%. Taking both variables into account, we learn that asset class number 1 has a better relationship between risk and return. The third variable, correlation, is a measure of how asset classes relate to one another. Shifts in the market and changing economic cycles cause asset classes to trade leadership. Over the 3-year period shown here, these 2 asset classes were extremely volatile. For Artesis purposes, they correlated very well. While mid-cap growth was the leader at the beginning of the 3-year period, mid-cap value lagged behind. This is called divergence. During market and economic cycles, asset classes diverge and converge. They trade leadership positions, as you can see at the end of the 3-year period. Understanding the correlation helps us reduce the risk when selecting and allocating between asset classes. For example, if an investor had invested roughly 40% of their money into mid-cap growth and 60% into mid-cap value, They would have reduced the volatility or risk in their portfolio, as illustrated by this black line. It evened out the peaks and valleys compared to the individual asset classes. That's the value of correlation. Later in this presentation, we will show you a technique that's aim is to get this portfolio to outperform its asset classes. We pull all three variables together to construct the Artesis portfolios. First, we plot each asset class based on its expected return and expected risk. When there are asset classes that have the same level of expected risk, we choose the one that has the higher expected return. So in this case, small cap growth. Since there are so many asset classes, we compare them in this way to find the best performers. By applying the third variable of correlation and filtering out the lower performers, you see what's left forms what's known as an efficient frontier curve. This curve represents a series of portfolios made up of the most efficient asset classes. It's how we know our portfolios are giving the appropriate amount of returns for the level of risk. Now that you've seen how the curve is created, let's see each of the portfolios. We offer 5 offensive portfolios and 3 defensive portfolios. To recap, a candidate for the Artesis offensive approach is someone who is confident that between now and their retirement date, the market will be greater in value than it is today. They believe that Artesis offensive, through its long-term buy and hold approach, can help them ride out periods of volatility while maximizing expected returns for their risk level. The 5 portfolios include conservative, moderate, growth, aggressive, and aggressive plus. We recognize that not all offensive investors have the same objectives or tolerance for risk. That's why each portfolio has a unique level of risk and expected rate of return and is composed of low, medium, and high-risk asset classes. Moving upward and along the curve, each portfolio assumes a higher level of risk in order to achieve a higher rate of expected return. While assuming different levels of risk, each of the offensive portfolios remains fully invested in the market. This is commonly known as the buy and hold approach. The methodology used to create the 5 offensive portfolios can be validated by comparing their performances to each other and the S&P 500. To do so, portfolio returns are reviewed over different market cycles versus during any one calendar year. Illustrated here is the S&P 500 during a declining market and a rising market. To set realistic expectations, let's see how these portfolios perform during a declining or bear market. On the inception date of this illustration, the Artesis portfolios and the S&P 500 are positioned relative to one another based on their expected risk. The S&P declined 30%. The aggressive plus and aggressive portfolios are engineered to take more risk than the S&P and therefore decline more. Built to take less risk than the S&P, the growth, moderate, and conservative portfolios are down less during the declining market. The performance distribution is in line with each portfolio's level of risk. And when we connect the 5 portfolios, we see the curve again, only inverted due to the declining market. This is a near-perfect distribution of returns, validating our methodology. And during a rising period of the market, also known as a bull market, the curve will rise too. Let's take a look. Once again, we compare the performances of the 5 portfolios to each other and the S&P 500. We position the 5 offensive portfolios and the S&P based on their expected levels of risk. Over the 5-year period shown here, the S&P increased 108%. Meanwhile, the aggressive plus portfolio finished up 131% and the aggressive portfolio 129%. These portfolios were engineered to assume more risk in order to achieve a higher rate of return during the rising market. The growth, moderate, and conservative portfolios finished at 113%, 90%, and 51% respectively, according to their lower levels of risk. They assumed less risk and therefore yielded less return. And when we connect the 5 portfolios, again we see the efficient frontier curve, a near-perfect distribution of returns that validates our methodology. For more current Artesis performance and performance since inception, please visit Artesis website. For the more conservative investor, we offer 3 defensive portfolios. A candidate for the Artesis defensive approach believes the market will go higher, but seeks to avoid volatility during periods of market uncertainty, as circled, in order to protect their holdings. The three defensive portfolios are conservative, moderate, and growth. During periods of market uncertainty, we will move some or all of the portfolio's funds comprised of stocks into more conservative fixed income alternatives. Growth, in which up to 100% of the portfolio may be allocated into equities. Moderate, in which no more than 72% of the portfolio may be allocated into equities, 28% allocated into bonds. And conservative, in which no more than 40% of the portfolio may be allocated into equities, 60% allocated into bonds. So how do we determine when to be invested in the market and when to move to the more conservative alternatives? Artesis Defensive has designed systems on each of its asset classes used when constructing the portfolios. Using sophisticated science, we have developed mathematical systems to help protect the investor from unnecessary risk. The system on each asset class has its own set of inputs. Seeking to optimize the performance of the systems, we search for the set of inputs that best predicts future performance of the asset class. Similar to our offensive approach, we look at historical data, only instead of monthly data, we look at daily data. Once we have found the optimum set of inputs, we apply it to the asset class. As each new day of data is added, the system generates entry or exit signals. An entry signal tells us it's okay to be invested in the asset class. An exit signal says this might be a better time to sit on the sidelines in money market funds. To set realistic expectations, it's important to understand that these systems are designed to protect capital, not to maximize growth. In other words, Artesis may not sell at the peak of the market in order to get you back in at the bottom. This means it is unlikely that defensive investors will capture 100% of the rise in an asset class. Shown here are two instances when Artesis reinvested in technology at higher prices than when they were sold. In other words, the investor would have been better off staying fully invested. These situations are called losses of opportunities and are the trade-off to a defensive approach. Just like with the offensive, the methodology used to create the defensive portfolios can be validated by comparing their performance to the S&P 500. Over two bear markets, $100,000 invested in the S&P declined to $70,370, as shown here. Meanwhile, $100,000 invested in the Artesis defensive growth portfolio increased to $111,700. A large part of this spread between this portfolio and the S&P can be explained by Artesis moving out of the market during periods of uncertainty, as displayed in the highlighted areas, thereby protecting the investor. We suggest the returns of these portfolios validates the defensive methodology. Visit our website for information regarding performance since inception on defensive growth, moderate, and conservative portfolios. Once you've selected the portfolio that's best for you, we actively manage your account, where we evaluate, select, and monitor funds deemed to deliver the best results, replacing funds that underperform. Artesis chooses the funds that best represent our asset classes, then reviews their performance over various time periods, comparing them to industry benchmarks. When a fund compares poorly to the established benchmarks, it is replaced by funds believed to be able to perform more to expectations. Periodically rebalance portfolios. Seeking to enhance portfolio performance, we use a technique called rebalancing. In the example shown here, it may have been tempting to chase returns by moving some money out of mid-cap value while it was declining and into the rising mid-cap growth. But notice here that by the end of year 2, the two asset classes reverse direction. Rebalancing is a process of redistributing profits from one asset class to another. By doing this on an annual basis, we seek to have this portfolio outperform the individual asset classes. Review portfolios to improve performance efficiencies. At the beginning of each year, we review the past year's performance of our asset classes. With this information, we can add, replace, or change allocations with the goal of delivering a higher expected rate of return for our portfolios without increasing the level of risk. Provide state-of-the-art quarterly performance communication and education. We believe strongly in ongoing communication and the educational value it offers investors. Seen here is an example of a presentation our investors receive each quarter. This illustration is provided along with a narrated explanation of their returns and the performance of their portfolio relative to the S&P. Through this simple presentation, we're able to keep investors aware of what's going on in their portfolio and provide valuable insights that helps them avoid common mistakes that could cost them returns. These are just a few of the ways your retirement account can be enhanced by active account management with Artesis. And if you're currently investing, we can help you see if you're being paid for the level of risk you're taking. By using our free online tool called PlotMe, you can see how your investments perform compared to the Artesis portfolios. Once you're plotted, you'll see if Artesis would achieve better returns for the level of risk you're taking. You may find that by moving to this Artesis portfolio, you can increase your expected return without increasing your expected risk, or reduce your expected risk while maintaining the same level of return by moving to this Artesis portfolio. It's a quick and easy way to see how your portfolio matches up to the Artesis portfolios. Whether you're well into your retirement planning or just getting started, Artesis can help you become a more successful investor. And though many of you may have different needs and goals, a few things remain the same. Retirement investing is a matter of balancing risk and return. Artesis can help you maximize returns for the level of risk you're comfortable with. Poor investor habits are more detrimental than poor investment performance. Artesis can help you avoid costly mistakes. Managing your portfolio effectively is a full-time job. Artesis actively manages yours so you don't have to. Now that you've learned all about Artesis, what's next? Let us take the work out of your retirement with Artesis.